Very warm welcome to all of you. We've been looking forward to this evening for quite some time now. We have some very learned, experienced investors, portfolio managers in the room, and one extra special guest with us whom we all look forward to listen to today. I would like to first invite Navneet Munot, who is the CIO for SBI Mutual Fund, and also now the president of CFA Society India, the society that we all belong to first come here and welcome our special guest and introduce him and the agenda today.
CFA Society, I welcome you all to this special evening. This is an auspicious week in India, so I wish you all a very happy Navratri and happy Dashera. This is celebrated across the country in different ways, but the spirit is same, a celebration of victory of good over evil. And we are in an investing world. For us, the evil is ignorance, not knowing what we don't know. And what is good? Maybe a sound investing philosophy, a framework, a robust investment process. And therefore, I think we are really fortunate to have a speaker today who not only has a long track record of producing an amazing track record, but also is kind enough to share his knowledge, his experience, and his wisdom with us this evening. And before I introduce him, I must place on record our thanks to our dear friend Saurabh Madan and Professor Bakshi for bringing him here and making this happen for us. His peers describe him as a good investor who's gone on to become great by knowing he's just good. Tom Gayner is co-CEO of Markel Corporation, a diverse financial holding company including insurance, reinsurance, and investing operations around the world. Headquartered in Richmond, Virginia, and founded in 1930, Markel has consistently been a top-performing company with a market cap of over $16 billion and revenues over $6 billion. In 2016, it was first listed on the Fortune 500 annual ranking. Tom joined Markel in 1990 and oversees all investing activities. He's also responsible for Markel Ventures, a wholly owned subsidiary which acquires controlling interest in manufacturing, technology, and service companies. Markel is known as a compounding machine. We all love that word. It has grown its book value by more than 20% per year since its IPO in 1986. This is even better than Berkshire Hathaway. Prior to Markel, Tom served as Vice President of Davenport and Company in Virginia and as a certified public accountant with PwC. He's a graduate of the University of Virginia and studied before at the Lawrenceville School. Today, he will talk about his journey as an individual and a value investor. After Tom's talk, we had planned to do a Q&A session with me and Professor Bakshi, but now we've got an interesting addition to today's evening. I'm sure all of you would have seen Saurabh Mukherjee's Coffee Can Investing series on CNBC. So today, we have Saurabh Mukherjee among us. He will interview Tom, and this interview will become part of the Coffee Can Investing series. So this will be the first series with a live audience on CNBC, which you'll be able to watch again for a few days later. Without much further ado, ladies and gentlemen, please join me in welcoming Tom Gayner.
It's my first visit ever to India, and I've been having an absolutely marvelous time, and I do wish to thank Saurabh Madan for compelling me to make this trip in so many different ways, but I'm grateful that he did, and I thank him for his connection and ambassador type role to so many people in India. A couple of weeks before the trip, I got a phone call from someone who you might recognize as perhaps not being from here, and that was my daughter, Sarah Ann Gaynor, who had heard me talk about this trip for months and developed curiosity herself. She is in business. She is with Capital One, a graduate with a business degree, and interested in investing as well as business, and has grown her up around our dinner table and wanted to come. And I said, well, that would be great. So she has joined us as well and enjoyed the hospitality and kindness of so many of you. I wonder sometimes, so as I'm saying hello and whatnot, I reach out my hand and I say, I'm Tom Gayner, and then you tell me your name, and I stumble over it because I don't really know how to pronounce it. It's a challenge for me. I don't know if Tom is as hard to say for me as your names are as hard for Tom is as hard for you as your names are for me. We'll just consider that part of the cultural differences which we're working to overcome and learn about. And also, you mentioned the name of the festival. Well, I wish you a happy that as well. So thank you so much for having me. I will just spend just a very few minutes talking about Markel and our story and how things came to be to some degree. And then I very much look forward to starting the questions, both from the other Saurabh, as you were described to me. This Saurabh says he's much more famous than you. We'll see how that goes. But then your questions as well. I much prefer to know what's on your mind and talk about the things that are of interest to you rather than a lecture. So I look forward to that. But very, very briefly, some of you have perhaps done some studying and looking at Markel. Markel is an insurance-based holding company. It started in the 1930s, and I'll just tell the story of the business a little bit, because the world of business and the world of investing sometimes are thought of separately. And that's a mistake. I think it was Buffett or Graham that said, investing is most successful when it is most business-like. So I think many of the themes that will come out during the course of this conversation this evening is trying to connect the notions of what defines and are markers of a good business and how that overlaps with what defines and the markers of a good investment strategy as well. So I'll tell you a little bit about my story, and again, it'll come out in the Q&A a little bit as well. But when in 1986, Markel went public. And let me start before that. So the company was founded in the 1930s by a gentleman named Sam Markel. And Sam Markel lived in Norfolk, Virginia. And Norfolk, Virginia is a major port town in Virginia on the eastern seaboard of the United States. It's also where one of the fundamental places where the U.S. Navy has its operations. So on the East Coast, it's Norfolk. On the West Coast, it's San Diego. And those are the big naval ports. So after World War I, veterans were returning from service, and many of them would come back to the U.S. through the port of Norfolk, Virginia. Well, Sam Markel had gotten there perhaps just a little bit earlier than that. And it's been one of the fascinating things to learn about India, and from having so little knowledge to begin to get some layer of the difference in the states and the difference in the languages and the differences of backgrounds and styles and cultures and cuisine and approach. Well, we have a similar sort of thing that happens in America as well, in that there are really, most of our country are immigrants from one place or another over a long period of time, and our country has absorbed those immigrants, and America is not so much a place as an idea. And one of the things I've learned so much in this particular trip is India, and the idea of India is not so much the place, but the idea of it, the culture, the assimilation, the joining together, and how that process continues. And that's been one of the fascinating things. But anyway, sometimes, that is a very half-full statement, and we can say that with smiles on our face and how happy. We also know that there are tensions and issues and challenges and troubles in building a common culture in that way. And there are hard things about that as well as good things about that. Well, Sam Markel was a Jewish immigrant from Eastern Europe, Russia, that part of the area, and he came to America and happened to land in Norfolk, Virginia. And I wish I had met him, because he must have been a very high personality, charismatic type of fellow, because here was a fellow who English was not his first language. So again, one of the things I've learned is what, there's 1,700 languages that were specified as acceptable in the Constitution, and there's 17 languages on the rupee note itself, just to describe the rupee note. So again, the notion of a language and the fact that you're operating and having transactions and conversations in not your first language, that's hard. So here was someone who was not born as an English speaker in a place called Norfolk, Virginia, which was a very conservative military town. It wasn't like San Francisco or Boston or New York City that are much more cosmopolitan and accepting of metropolitan ways of doing things. So I got on the city council, and the veterans were coming back from World War I. It was the early days of the automobile industry. So cars started being on the road, and taxis started to come into existence, and people would drive these taxis, these veterans drove taxis, and there started to be accidents. And as accidents would happen, people were hurt. There was a desire to, Sam Markel got a law passed that you couldn't operate a taxi in Norfolk unless you had insurance, so that somebody would be covered if something bad happened. And there was no insurance company that was willing to do that because it was brand new. It was a new idea. There was not data, not actuarial data. We talk about data all the time. That's sort of every other word in today's world. But that was a world with no data to speak of. So it was art as opposed to the science of data. And everything is a blend of art and science, but that was way art and very, very little science. So he started this insurance company to do that. And then as luck would have it, the automobile continued to be developed and refined. Trucks got developed and refined. The highway system, the roads that linked commerce all around developed. For 30, 40, 50 years, it was a great tailwind to work with. And Markel really became the leading company at transportation insurance. And from the 30s to the 50s, and that was especially where you knew things, and every day that went by and every car that you insured, every truck you insured, every accident that you went through the whole process, you were gathering data and learning about what the actuarial loss expectations of the insurance product was. Well, by the time you get into the 1940s or 50s, everybody had the data. There's a lot of trucks, there's a lot of roads, so there was nothing special about it. There was nothing that other people weren't willing to do as well. So the profitability, like every other business in the world, began to diminish. So the next phase of Markel, which was really driven by creativity and the thought of what do we do next and what do we do now? What problem can we solve for people? What can we figure out that is a way for us to take care of our customers that not everybody else can do? That was the next chapter. And the way that actually happened for Markel is that Sam and his four sons, the second generation of the business, predominantly became agents of Lloyd's of London. And you think about insurance, you think of Lloyd's of London, and you think about any kind of oddball or different or non-standard kind of risk that standard insurance companies won't do. That is what Lloyd's has been known for hundreds of years of being willing to do. So Markel became largely an agency function for Lloyd's type risks in the U.S. and predominantly in the Richmond regional area, the south of the U.S. And that went on for 20 or 30 years. And then it came time for the third generation to think about joining the family business at that point. And of the 12 cousins of the third generation, 3 of them joined and became part of the business. And one of those 3 was a gentleman named Steve Markel. And he was the most financially oriented of those 3. He was the gentleman who hired me. And what Steve observed was, well, wait a minute, we're collecting premiums in America. We're sending them over to London. And then if an accident or something bad happens, we get some of that money back in order to pay the claims. Seems like there's friction back and forth in carrying the money over the Atlantic one way and then back this way. So he had the idea that instead of predominantly becoming an agent, why don't we become an insurance company and start underwriting those risks internally within Markel? And that's what they started to do in the 1970s. So from the 70s through the mid-80s, they just bootstrapped it and with very little capital. So if you sold $1 million policy, Markel might be able to retain $10,000 of the risk, but then you had to reinsure $990,000 back to London in order to just have the balance sheet and the capital strength to do that. And then if you made a little money, maybe next year you kept $15,000 of the risk and reinsured $985,000. So it was a steady but very slow pace of bootstrapping and building the financial wherewithal of the business to be able to accept insurance risks, because you must have some balance sheet, you must have some capital you must have some money to be a credible person who can accept insurance risk. So in 1986, they went public and started to raise some capital. And that also served multiple functions. In addition to raising the capital and accelerating the bootstrapping process, it enabled the 9 members of the family who were not in the business to have liquidity for their business, but so they could sell off stakes in the business bit by bit or piece by piece over time as they wanted to do so. It allowed the 3 to solidify their position in their role. And speaking very personally and very importantly, it allowed people who were not members of the family. I mean, I'm not a Markel. I did not marry a Markel. It enabled people like us to join the business and buy stock and become equity owners in the business over time, which has worked out very well, both for me and for a lot of people over a long period of time. So in 1986, when Markel went public, that's when I was working in the investment business by that point, after a short stint in the accounting world. And luck of the draw, I was the analyst who was assigned to cover Markel. So I got to know Steve Markel through my job as an analyst covering the company, writing reports and things of that nature. From 1986 through 1990, he became a client, he became a friend. 1990, Markel did an acquisition where they bought a company that was larger than what they were. So they more than doubled the size of the company at one fell swoop. And Steve had been operating by himself, thought he might like a wingman to help him out. Said something to me about joining him. I said, well, that sounds like fun. And I've been there ever since. That was 28 years ago. Now, one of the reasons that I was so anxious to do that and make that move and said yes immediately was because connecting the dots to the question about, or the statement about Berkshire Hathaway in the introduction. 1984 was when I first read an article in Fortune magazine about Berkshire. And I saw and observed, just with an accountant's eyes, what Buffett had done, where he had taken an insurance company that was profitable and taken the profits of that business and invested it in other businesses, common stocks, and then eventually wholly owned businesses. And that was the formula by which Berkshire was built. And here I observed the opportunity for that to take place in Markel in Richmond. So it was a very small, tiny insurance company at the time, but they were profitable. They were willing to think long term, and they were willing to be very creative. So figuring out the next thing to do was always part of the DNA and always part of the culture. So I jumped at the chance to do so. So that's when I joined. Started off with looking over the investments. The total size of the company at that point was $40 or $50 million of total assets on the balance sheet. The day I walked in the door, Steve Markel gave me $2 million to manage, which wasn't a lot, but it wasn't nothing. And I did well with that $2 million, and then it became more, and he just sort of kept pushing the responsibility over to me as time went by, and I became responsible for all of the investments. And by 2005, which was 15 years into it, that's when we bought our first wholly owned subsidiary that was outside of the insurance business, a bakery equipment machinery company at that time. And we bought 15 or 16 similar businesses in various industries over the years since that. That's roughly a $2 billion revenue run rate business these days. The insurance business is roughly a $4 to $5 billion revenue run rate in terms of premium collection. We've announced some very significant acquisitions over the course of the last 2 years in the insurance business, as well as our non-insurance operations, which I think really create the opportunity for us to continue to adapt and change with the way the markets are changing and the way technology has changed the fundamental premise of how insurance products are created, analyzed, and managed. So it continues to be a place that has a lot of energy, a lot of fun. It's driven by, as I said, the creativity, the integrity of people who are committed to doing what they say they will do, that are committed, the festival, the comment about good, victory over evil. Again, we're all for that. And we think one of the hallmarks of a great business and a great investment is a company that does things for its customers rather than to their customers. And in last year's annual report I wrote, I think there's 3 sets of people that you are doing things for, starting with your customers, doing things for your customers. Secondly, for your colleagues. for the people you work with and trying to create opportunities for those people. And the day I walked in the door in Markel in 1990, we had something on the order of 300 people that worked for the company. We're up to close to 16,000 now. So that's a lot of other people and families that draw their sustenance and support and livelihood from Markel. And then pleasantly enough, and this is also what connects us all, that's for your shareholders, for your community of people who have supported you financially along the way. So that is the brief thumbnail story. My daughter has informed me that I've rambled on for 15 or 20 minutes already. So I'm happy to shift over to the Q&A and look forward to Saurabh's Q&A and then the Q&A from all of you. So thank you for your welcome.
So welcome to Copy Can Investing. We are in New Delhi today. We have a live audience. More importantly, we have with us Tom Gayner, co-CEO of Markel Corporation, a Fortune 500 insurance company, and Tom himself has a stellar investment record. Welcome to the show, Tom.
Thank you so much. Glad to be here.
So I thought we should start at the beginning of your career life. And from the sounds of it, you had a upbringing in a farm in New Jersey. Your father was an accountant, but he ran a liquor store.
Yes.
Now, all of that from an Indian perspective is very exotic, right? Most of us have not even seen a farm, let alone been raised in a farm. So if you could just take us to those early days and how they influenced the career that you went on forward.
Well, thank you very much, and I do appreciate going back to the very beginning of the story. So, yes, I grew up on a farm, and it was 100 acres. Sometimes people think of New Jersey as a place that doesn't have so much in the way of farms, but actually there are large parts of New Jersey that are quite rural, and southern New Jersey, where I was from, is a place like that.
Right.
And then also people think of New Jersey as a place that is a major metropolitan area that's very populated and somewhat crowded. Well, I think those people have never been to India.
Right.
So we have absolutely nothing in terms of metropolitan areas and people joined together. So yes, my upbringing perhaps might be extraordinarily different from you in the sense that my sister was 18 years older from me and already off to college by the time I was born. My brother
I see.
14 years older than me.
Wow.
and almost off. So by the time I came along, I was somewhat of an only child kind of thing. So yes, you have 100 acres in yourself. To some degree, part of the value of an upbringing like that is you're left to your own devices and your own imagination to find ways to amuse yourself and come up with things. So running around and reading books and all those sorts of things were very valuable. You mentioned my father, who's a key figure in my life. He did indeed start out as an accountant. He worked in Philadelphia at the beginning of his career, which is a major city, but later on he decided to go back to his hometown and rural area to begin a different phase and style of his life. So by the time I came around, my father was established in business and perhaps had a bit more time for me, and I loved and admired him very much, and he had his office in our home. So for the tax work he did and the accounting work he did, actually that office was in our home. So I got to just grow up. When I came home from school every day, he was there and he was talking to people, and I would just go and sit in his office and do my homework and listen to him talk to people, listen to him talk to the phone, see people come and go. I saw him read the Wall Street Journal every day, and if my dad read the Wall Street Journal every day, then I was going to read the Wall Street Journal every day. So the nature of our relationship, in addition to the normal father-son things one would do, which in America would mean talking about sports or something like that, we also talked about business. And in addition to talking about business, I got to observe it firsthand by seeing him in his daily activities.
So I suppose that's why perhaps it was a reflex decision almost to become an accountant after you graduated from the University of Virginia. You've seen your dad do it. You've been discussing accounts and business for all those years.
Yes, absolutely. So as a child, that was my understanding of what accountants did. So he had his office right there. He was in charge of his day. He had clients. He had the liquor store business. He did small real estate deals, different deals around the county.
Very interesting.
He met with people, all those sorts of things. So I thought that is what accountants did. And I went to the University of Virginia, and I studied accounting, and I went to work for PricewaterhouseCoopers as the lowest of the low staff accountants. And of course, they would send you out and about to count things and do inventories and be in small dark rooms adding up numbers. And I thought to myself, I made a mistake. My dad got to talk to people. He was an extrovert and put deals together. So I said, why? I need to do something differently than this. And that was part of the path to shifting over to investing. But my daughter, who's with us here, and is a dutiful daughter. And when she went off to the University of Virginia and started in the business school, her initial thought was to study accounting, because she had heard me talk, and very positively about accounting, in the sense that if you want to be a good business person and you want to be a good investor, I think an understanding of accounting is very important.
Couldn't be more.
Because it is the language of
Yes.
business.
Yes.
So you need to understand the language of business. So she started off in accounting and was taking the first accounting courses, and I got a phone call from her, and she said, Daddy, would you be disappointed in me if I switch my concentration from accounting to finance?
Right.
And I said, no, I completely support that decision 100%. She figured it out quicker than I did.
Fabulous. So from accounting via stockbroking, 1990 you entered Markel, and you haven't left ever since. And in a world where people change jobs as frequently as they change cars, this sort of loyalty in the investment management profession, even in the American context, is very rare to see. What's been the driver of this unwavering faith and loyalty to one institution over a 28-year period?
Well, thank you. In some of the meetings that Saurabh was kind enough to arrange with different entrepreneurs and different leaders here in India in the business community, the notion of loyalty was discussed in more than one case. And while that is a qualitative statement rather than a quantitative statement, the second and third and fourth order effects of what it means to be a loyal person, actually that I think helps people to be loyal to you.
Right.
There is a reciprocity that's involved in loyalty.
Give and take.
So frankly, you invest yourself in not Markel, but the people of Markel, your colleagues, your friends, that win-win structure. And if you invest yourself with good intentions and good spirit, odds are that's going to come back to you in a compounded return sort of fashion. So that dynamic has happened, which has been fantastic. The second level of that is that, as I mentioned, Markel, when I joined, I sort of have the same job today that I had when I started.
Amazing.
Called looking after the money.
Right.
That's my job.
Quite an important
Look
job.
after the money. Well, there's a lot more money to look after today than there was back then. So yes, it's the same job and it's the same title, but the world has changed, the new things that you see, the new businesses that we have entered into, all of those things have been new, they've been vibrant, they've been creative. So yes, it's the same company, but it is, and yes, it's the same job, but it has been a different experience sort of every year as we go
just
along.
Extending that point forward, there's a quote from one of your interviews, and I'll read it out because it's a very interesting quote. You say, "It has been my experience that the richest people were those who found something good and held on to it. The people who seemed the least happy and the most frenzied and the least successful are those that are always chasing the next hot thing." Now, India, many of us are frenzied and most of us are chasing the next hot thing. So could you please throw more color? This is a very interesting statement and a very interesting point of view. How did you come up with it?
Well, I'll give you an example from my personal life that might seem like it has nothing to do with investing at all. But let me ask you this: how many people in this room are married? How many are married? All right, so a lot of people are married, and think about how it is that you met your spouse, and how that took place.
Yeah.
Well, fortunately enough, in my life, I happened to start dating the woman who I am now married to at age 15. And of course, in America, we don't have the arranged marriage or that tradition. We have I guess when Warren Buffett was visiting India, he was seated next to someone, and the story was that this woman who was sitting next to him was exchanging stories, and she said, to him, "Oh, you have a hormonal marriage." And he says, "You're damn right I do." So, so I was lucky enough to meet a young girl at age 15 who I fell in love with, and the amazing thing is she actually liked me back.
Right.
So I thought that was spectacular. And so I invested myself in her and loyalty to her, and I am still married to her 37 years later, and that relationship has grown and blossomed and developed over that period of time. Well, why is that different than the way you can think about a business and the way you can think about investing? If you find partners in life, in business, and anything, and everything that you do is accomplished through other people. Even if you're completely a technologist and you sit in a laboratory, you are not alone. You are doing things in the context of other people. So the same things are analogous to, I think, the thought patterns that if you really are oriented and think that way, it will surprise you how pleasant the financial implications are of that.
So that in turn leads us to Berkshire Hathaway. So from what I've read, this was the first stock you bought at Markel.
That is correct.
And you've never sold it. And I think what's fascinating about talking to you is, given that you manage money for an insurance company, so the rest of us, who've heard about this magical float that Berkshire's investing companies have, the float that Warren Buffett talks about. Can you give us a sense as to, firstly, your own investment thesis around buying Berkshire and staying invested for 28 years, but also your understanding as the guy who looks after money for Markel as to what exactly is float and why is it so powerful?
Right. Well, let me try to unpack that and answer both of the things you said. So in the first part of your question, you're talking about the magical flow.
Yeah.
Well, let me assure you, and I want to address the colleagues of Markel who are in the insurance business, there is nothing magic about flow. Okay. That is distilled hard work. So in essence, when you're taking insurance risk, you are taking risk. And one of the things that people often get wrong, and when they think about insurance, is somebody handed you money today, right now. You get money today, and you make a promise to give them some payment later on in the future if something bad happens. And as Buffett himself has acknowledged, if you think about a con man or somebody trying to scam people, it's the same thing. You're trying to get somebody to give you money today for a promise about what you're going to do tomorrow. So how does a scam and an insurance policy differ? Well, at the beginning, they don't differ at all. In the fullness of time, then you start to understand and see the difference between the two. And the ability to take some money today to internally deal with the temptation that if somebody's willing to hand you money, what you would like to do is have them hand you more money. Now, there's only a certain amount of money that you can take, that you can accept that risk on, that you're knowledgeable about enough to understand the parameters of what you might have to pay in the future and the uncertainty that's involved with that. And there's only a certain amount of money that your personal balance sheet and that your capital position should constrain you from taking. But it is a huge human temptation to want to take more than that.
Overextend yourself.
Exactly. So the work of figuring out that pricing and handling the claims and living with that discipline, that is a tremendous intellectual process, a tremendous amount of work, a tremendous amount of discipline all involved. So I just wanted to make sure we didn't have a false implication of the magic flow. But if you do that right, and Berkshire has done it right for many, many years, Markel has done it right for many, many years. There's a thin list of insurance companies that have done it right for many, many years. Not a lot, but a thin layer of companies that have had that discipline. Well, then indeed, you do have that pot of money, which you are holding and you are able to invest. And in addition to the corpus of the money you have, all of the income from those investments accrue to you as the equity owner of the company.
Right.
So that's it in a nutshell. And if you can get it so that your insurance colleagues do indeed manage the float such that it has a negative cost associated with it, well, if you have money handed to you that you're paying less than zero in interest and you're earning more than zero to some degree. That is a positive spread. And if you do that at a positive spread for a long enough period of time, sheer, pure mathematic, it hockey sticks compounds
Right.
to great sums.
Right. So just to sort of paraphrase this another way, the skill of your underwriting colleagues gives you the float, and then if you invest the float wisely, you get a further investment income on it, right?
That's exactly
So there are
right.
two sets of skill at work: the underwriting.
And it is a reciprocating skill. And again, one of the things that I've culturally enjoyed about the sensation of being in India is these ideas of more than one way, that there are offsets, that there are multiple paths, that there are compositions of things that lead to more truthfulness rather than less without a single definition of truth. And done well, these things are reinforcing, and done poorly, they collapse and fall apart. Well, if you think about the underwriting colleagues, one of those things that I said you needed to have was the capital base to accept the risk.
Right.
So if they, with a small amount of money, accept good risk on that capital base, and they in turn entrust me to manage that for them, and I do it well, well, what that does is that gives them more capital,
Right.
more presence in the marketplace, more attractiveness as a potential bearer of that risk.
So it becomes a virtuous
It's
spiral.
a virtuous cycle, that's exactly right.
And is it right to say that that's been the core driver of your own investment in Berkshire Hathaway
Yes.
for such a long period of time?
Yes, that's a single way of describing it,
Yeah.
and there are other layers involved, just
Right.
like I've been learning and absorbing on this trip. But yes, that
Very
is
interesting. And it's what's fascinating about it is this whole element of value creation is still relatively unknown in India. We have fine insurers in India, but we haven't yet found an insurer who can marry a supreme skill on underwriting with supreme skill on the investing side. But I'm sure that sort of financial services firm will come along in the next decade or so. But let's move on to another element which links into this. It was a 2015 interview with Jason Zweig, and you said, if you stumble on something that really compounds in value for decades, it can make all the difference. The things that you were right become more and more important as time goes by, while the things you were wrong about become less and less important. Now, this in a way is what we sort of love to believe is the essence of coffee can investing.
Right.
But you've put it in a very interesting manner. Could you again just help us understand this a little bit more?
Well, yes, there's a couple layers and a couple ways I try to illustrate that. So I can remember as a child growing up, like your show, Coffee Can Investing, back in the 1970s or so, there was a show on public television in the United States called Wall Street Week with Louis Rukeyser.
Okay.
And it was on Friday nights. And this was before I met my wife, so on Friday nights, being a lonely nerd that I was, I'm sitting there with my grandmother watching Wall Street Week with Louis Rukeyser. And we would talk about the stock market, just like I talked to my father. My grandmother was interested as well. And my grandmother was a fascinating woman.
Right.
Many, many stories about her. But she was a woman who, when my grandfather died, she did not like to make decisions.
I see.
Sometimes people were like that.
Okay.
So my grandfather was a small-town businessman, and he had 12 or 15 stocks that small-town businessman would kind of have as a normal investment approach. And when he died, she lived in the same house for the rest of her life. His suits hung in the closet.
Right.
His shoes were on the floor.
Right.
And those 12 or 15 stocks that she owned,
Right.
she never sold them.
Fascinating.
She held them, and she never traded at all.
Okay.
Well, among those 12 or 15 stocks, she owned PepsiCo, Lockheed Martin, and General Public Utilities, which was the utility company that served New Jersey and the area. And it really didn't matter what other ones you owned,
Right, those three.
because those three were multi-decade compounding machines.
Amazing.
And they swamped the returns of everything else. So if you actually did her numbers, I think she'd be in the 90th percentile of investors.
Amazing.
And that's because she found some things that were compelling ideas that had multi-decade
And you could
roots.
see this happening in a portfolio as you were growing up.
Well, as a 10-year-old, it's hard to have that kind of perspective. But as an 11-year-old, I appreciated it a little bit more than I did as a 10, and it compounded from there.
Amazing. Amazing. So Markel itself has been described by
And if I could actually, so one other story, again, just to tell you what sort of a strange and twisted childhood I had in this. So when I was 14, the tax laws in the United States were changed such that that was the year in which they created individual retirement accounts, IRAs as they're commonly known. I was 14 at the time, and I was doing a part-time job working for my father and making a little bit of money. And that year, when I was 14 years old, my part-time job helping him out at the liquor store and whatnot, I made $700.
Okay,
And I took that $700 and I put all of it
Yes.
into that IRA because it was tax-free. Not that the tax rate was very high, but I started an IRA when I was 14 years old. I still have that account today.
Amazing.
And it would be surprising what that has compounded to over a period of time, because it's been, close to 40 years, more than 40 years of that, and putting money in it every year. The taxes are deferred, so it grows tax-free. But that's the coffee can approach.
Right. So Markel itself has compounded at high teens since IPO in 1986. And I think as you were describing, there are various phases to the firm's evolution, right? It's done insurance in different areas. It's tried its hand at Lloyd's, the Lloyd's syndicate, and so on. And yet the company's been able to give this enormously steady compounding over the best part of 40 years now, best part of 30 years. What's been the driver of that steadiness, that ability to keep grinding away high teens return in the context of the U.S. market? In a time when the S&P 500 probably gave 6, 7, 8%.
Right. Well, the base rate over that period of time is probably a little bit higher than that. So we have had a bit of a tailwind to work with. But I think while it would be impossible to describe fully and accurately all of the factors that went into things, the two base pillars to me would be that notion of the creativity and the integrity. So creativity, starting with Sam Markel, starting with the company, that's embedded in the DNA of the company. So we recognize that the world spins, the world changes, new things happen, new ideas come into being, the world of technology, which is so much in our mindset these days, the world of data, the notion of data is the new oil, and what all of that means, the creativity of the new and the creativity of destruction and the change. Well, you can't know exactly what you're going to do, but you know you need to be doing something and figure it out. And that's just in the DNA of the people of Markel, not just me, that's the organization itself. So that's very helpful in driving things. And then the aspect of integrity, again, tying to your first question about loyalty. Integrity is when you give your word is your bond, and if you say you will do something, then do it. And if you say that you can't do something, avoiding a situation, for instance, where a lack of integrity would be called for, then don't do it.
So be firm.
Be firm, yes. Again, in one of the meetings that Saurabh set up today, I think it was Uday Kotak who said, we would rather say no today than say I'm sorry tomorrow. So that notion of being able to not do is just as important as the doing. And it is the balance between the two. Because if you overdo either side, if you do too much without the appropriate realm of caution, you'll drive the car into the wall at some point. Yeah. On the other hand, if you say no all the time, you'll never do anything.
Stagnate. Yeah.
So you'll stagnate. Yes, you need to balance those two forces.
Your own investing style has clearly worked over the best part of 30 years now, and as you explained a few minutes ago, there's a link between Markel's success and your investing style. Could you throw more color on how, as the firm has grown bigger, and you've managed progressively larger sums of money, how you've continued to be able to outperform the broader market?
Well, thank you. For me, the path of investing started in the disciplines of accounting. And I think for so many of us, and if you're CFA charter holders and you've gone through that exam process, they make you do equations and calculate. They don't ask you to write poems to figure out how to be an investment. But you know what? Actually, there's a certain amount of equations and calculations that you should make. But if you really want to be a great investor over a long period of time, you probably ought to be able to write some poems too. There comes a point where there's a shift of qualitative understanding that comes from the firm grasp of the underlying
Accounts.
quantitative data that's underneath it. So really my path from the very beginning has been to naturally gravitate towards the financial statement, towards the numbers, to calculate ratios, to understand those things, but then recognize that what the numbers should do is tell a story. What's the story? What do they mean? And how did they come to be? What were the driving forces? What were the factors that made those numbers come into being? They're manifestations of somebody's efforts and somebody's plans and somebody's strategies. So as you understand that and you connect that, I think you begin to be able to move towards making some judgment, imperfect, but some judgment nonetheless about the future and what is likely to happen given what I've been able to discern about the forces that have caused these things to happen. So that leap into the future is a leap from quantitative to qualitative to make guesstimates about what the future quantitative results are going to be. And that's really what we're doing.
Very interesting. So, if we try to look at the American context, the world's largest economy, world's largest stock market, and someone who's watching the program and is a cynic about coffee can investing will say, well, it's all very well for people from the developed world to talk about trust in businesses and trust in high quality businesses in Berkshire Hathaway, but surely these sorts of notions don't work in a developing country like India. We are what Francis Fukuyama will call a low trust society. The business models and the values by which you've lived your life and you've lived your career, do you think this format of investing and doing business will work in India as well?
Yes, I do. And the political leadership of India and the changes that have taken place in recent years and the forces, and does this continue, does this go backwards, sideways, and the conversation was around those things.
Right.
And in the context of that conversation, there was the observation that was made that at the same time in India, you have some of the most successful, wealthiest people in the world and some of the poorest in the world. But those people who are very wealthy and very successful, in many cases, those are relatively new businesses. Those have been developed not overnight, but over the course of one generation.
That's right, 10, 20 years.
Exactly. Yeah. So, given all of the challenges and all of the things you talked about, how is it that within this country, you've already seen people who were able to operate and build trust and great business franchises and wonderful businesses despite all the headwinds? And now perhaps you're operating in a period where you might have tailwinds instead of headwinds,
right,
and the knowledge of everybody in the country because of access to smartphones, technology, understanding of what's going on everywhere, not just what you can see in your physical location. It seems to me that those sorts of changes are irreversible.
Right.
And the distinction between what any human being's expectations would be of life, no matter where you are in the globe, they're converging.
Right, so values and behaviors are converging.
Correct.
Very interesting. Warren Buffett clearly has been a massive influence on your thinking and how you invest. Other gurus, other influences, other books that have shown you the way forward in your career?
Well, for instance, the way Saurabh and I first connected, I think, was over our mutual respect for John Wooden, who was the basketball coach at UCLA. So I love reading history. I love reading things about people who were great business people, who were great military generals, who were great athletes, who somehow made a positive mark on the world. So, yes, Warren Buffett, my father, John Wooden, Charlie Munger, Howard Kirby from the Coffee Can Investing, all of those folks, John Templeton, and what he, not just his investment results and ways of doing things, but the values and the thought process he had and the notion of a positive force and positive changes that he was part of for his lifetime. Those were all influences and people that I studied.
So there's a number of, I can see a number of young people in the audience here. There are plenty of people who watch this program who are youngsters who want to build a career in investing along the lines of what you've built. But they'll be trying to figure out, should I do an MBA, CFA, CA, should I become a financial planner? For aspiring investors out there, what would you suggest in terms of reading and career planning? What's the best way for an aspiring investor in his early 20s to plan the next 10 years of his or her career?
Well, it would be immodest of me to suggest what is the best way.
Right.
And it also would be incorrect because that answer is different for different people. Mm-hmm. So we have a professor here with us who teaches students and uses disciplines of behavioral economics and finance to try to impart knowledge. I was speaking to a gentleman who runs a jewelry business earlier, and his knowledge of his business and the buying and selling and the way of treating customers and all those sorts of things that he has learned through that business.
It's very different.
That would teach you something about investing if you can connect the dots and figure out, since this is true in what I know, would that also perhaps be true in something that I don't know as much about? Can you transfer knowledge? So whatever knowledge base you have, whatever you're starting with, try to be as skilled and as good at that as whatever you have, and then figure out ways to transfer it. So for instance, my wife, who runs a business for us, she started out her life as a chemical engineering and chemical engineering, but runs a business and runs a wonderful business.
Transformation to engineering.
Well, it's because she's learned the disciplines of engineering help you to do the math, help you to understand cause and effect, help you to think of the system and the design, and if you change this variable, it changes other things within the system and the design. Well, that's true with people and businesses as well. So there's no one path. It depends on where you find yourself and what you're good at and how much curiosity you bring about things you would like to know more about, and your skill at learning and absorbing and compounding your own intellectual power as time goes by.
Thank you, Tom. That was very useful. Thanks for sharing your insights with Coffee Can Investing. That's it from us from New Delhi. Thanks to the CFA Institute for giving us this opportunity to hear from Tom. We hope you enjoyed this version of Coffee Can Investing. Thank you.
Thank you.
Thanks.
Something and make a calculation or estimate of what I think that company is worth. Oftentimes the market price would be meaningfully higher than that, so there'd be a gap. And if you're right about your valuation, you probably should not buy it. I would not make it as an absolute statement in the way that you asked the question that always happened. Doesn't always happen. Sometimes it happens. When that happens, then there's I think a next level of questions that I ask myself. Okay, so this is what I think the business is worth today, and this is what it's selling for. But a year from now, what is that business likely to be worth? If it's a good business, it's going to be worth more. So the direction of that trend will be up this way. If it's a mediocre business, then it's very likely that it will not really increase in value and perhaps be worth even less. So as a technical matter, if I observe a gap, the next question I ask myself is, all right, what's happening to the trend? And if I think it's a positive trend, then I think about what the slope of that line is and how long it takes to intersect. And it might well be that a good business intersects with your value line sooner than you think it might. And rather than make a total decision, make a little decision and buy a little bit, because if you buy a little bit, you'll understand the company even better and you'll know more and more. And if there is some sort of market reaction which gives you a better entry point, I think you're more likely to act on it if you already own at least a little something. So I hope it's helpful. And I think you guys want to, yeah. Sorry to jump on the Q&A there, but.
It's very qualitative, right? I mean, it's so tough when you are looking at someone, and these days, the CEOs and of course the CFO, I mean, they know what the investors want to listen. And then you have people in the investor relation who come, the best analysts from the sell side, so they know what the story to be told. Then how do you really assess the management? If you can elaborate any anecdotes of good people versus bad people, some of your experiences on that?
Sure. Well, I'm 56 years old now, so I didn't just start yesterday. And in the accumulation of time, that ability to make qualitative judgments about people, I think it improves over time. Just because you've met more people, you've been in more settings, you've experienced more things in your life. You've experienced when people have looked you in the eye and represented that they will do something and that they are great people, and not lived up to that. You've met others that did live up to it, and I think you develop an intuitive sense that you should be more and more confident about as time goes by, and you should also recognize you're going to make mistakes. And I still make mistakes where I conclude that somebody is of integrity and I can work with them, and there are subsequent things that break that trust and violate it. But then you just have to move on. You have to learn and try to do it better the next time. But I don't really have a formulaic answer to that, but the passage of time is quite helpful. And if you look at CEOs or CFOs running a business, if they've been in that job one day, you have 1 day's worth of data, hard numbers, quantitative things, by which to see if the words and the story and the narrative matches up with the numbers. After 2 days, you have twice as much. A year, 2, 3. So with the fullness of time, even in just the passage of time, you get to see the trend line of what you thought they were as a human being, which is completely qualitative. But you do also get to see the financial ratios and the numbers and see if those trend lines seem to be heading in somewhat the same direction or not. So that's one sort of quantitative way of confirming those sorts of judgments is look for directions, and directional information comes with the passage of time.
Okay, we have a question from the audience. I don't know the name of the person, but the question is, Charlie Munger says that he has never heard an intelligent discussion on cost of capital. Now, on the investing side, when you deploy capital, how do you think about that?
Well, maybe it was my daughter that asked that question. So I'm going to tell a story about this question. So she's denying that she said it, that she asked the question. Somebody else asked this question. Okay, so I believe her. So there's someone who said, I will tell you a story about her. So when she was at the University of Virginia, and she was in undergraduate business school, and in that finance class that she concentrated in after the accounting, the first project, and the first really big project they had to work on as a group, was calculating the cost of capital on something. And there were 4 or 5 people in the group, and they stayed awake for 36 hours in a row and doing all these calculations and come up with a number of 10.143% or something like that. And that was the paper that they handed in. And she got a good mark on it. But she did subsequently, after turning it in, call me and say, hey, Dad, what did this cost of capital thing and all this calculation, the beta, the volatilities and all this stuff. What do you use when you're thinking about cost of capital? And I said, about 10%. With that much work involved in doing so. And she nearly cried, but she did go back to her professor and explain to him that, my father is in this world, in this line of work, and needs to kind of think about cost of capital and making decisions. And I asked him, how did he come up with that number, about 10%? And he's done all right with it. And the professor, to his credit, said, well, your dad is right. We just don't know how to teach that. So I hope that perhaps qualifies as somewhat of an intelligent question about cost of capital. So to unpack that just a little bit more, you start off with the base rate of interest rates. You don't need to guess about that. So I operate in the U.S. markets predominantly. The 10-year Treasury is 3-something. The 30-year is 3-something, like that. So the risk-free rate of return in the U.S. market would be 3%. Historically, the equity risk premium should be round numbers, 3-4% on top of that. So that gets you up to 6-7% for a cost of capital thought process. And then I would add a little bit to that, because to take equity risk for less than 10% seems like a bad idea to me. Just rough terms. Even though with my thought process, and that cost of capital has been coming down for 30 years. So, if my daughter asked me that question 10 or 15 years ago, I would have said about 12% or about 15%, because I can remember the 10-year Treasury in 1990 when I joined Markel and first was in a position to make these sort of decisions was probably 8 or 9. So I would not have just said 10 to her on that question. I would have said 15, because you start with the base rate of interest and add some factors to that to get with rough numbers. But I would also say the rough number is a good number to have, and it's a false precision to start adding decimal points and going too far past that, because there's just no way you can know the future. And again, when we were riding around today, there was a situation that had come up where somebody was pressing for more information, more data before they had it. And a friend of mine, sometimes when he gets on the wrong side of somebody asking him more and more and more, he says, "I've already told you more than I know." And here's the next derivative of why I think it's a bad idea to come up with a 3 or 4 decimal point answer to that sort of question is when you have that false precision. I think the next thing that human beings do is they start to use leverage to get a better ROE. And if they think they have certainty about what these variables are, the math is not that hard. You can do the equation. It looks lovely on the computer screen. But in the real world, if you lever it, you've introduced fragility into the system, and however great a result you could have created, as Charlie Munger says, any number, no matter how large, multiplied by 0 is 0. So again, that's why I back away from the false precision of that. Now that being said, the other thing I want to add, I'm speaking for the profession of finance and investments, where approximation and roughness is an important discipline, because the tools tempt you to be more precise than you really can. If we're talking about, I'm going to get on a plane in a couple of days and fly 14 or 15 hours back to America. You know what? All of the people who built that plane and fly that plane and do the navigation and the coordinates of that plane going from here to there, I want them to be very precise. Because otherwise the plane will fall from the sky and we'll all die. So I don't want that to happen. It depends on the situation. Precision is a spectacularly important thing in certain situations and certain professions. Aerospace being one of them, but finance not so much.
So I think that means that you don't use Microsoft Excel.
Well, the old joke is, and I know some of you have been to Omaha for the Berkshire meetings, and Buffett, talked about discounted cash flow, which on Microsoft Excel is not mathematically or technically challenging to do. And Munger, in his very Munger-like way, one time sort of got tired of hearing Warren chirp about all this and had his arms folded like that with his gray suit, and he says, Warren talks about discounted cash flows all the time, but I've never seen him actually do one. And he was right, but again, speaking to the discipline of finance, where again, I think approximation is a valuable tool. You should do a discounted cash flow, but you should be doing it in your head or a piece of paper like that, and it should be enough right and directionally correct enough right to give you valuable insight and valuable data.
So let me just take one more. A related question to this was, so imagine that you have a 10% threshold that you look out for, given that the interest rates are so benign, and you have a whole bunch of opportunities that you understand, which will give you a return, which you think will give you a return of at least 10% for the.
I like imagining this scenario so far.
How do you choose? And if you choose, how do you decide how much goes in A and how much goes in B?
Well, roughly speaking, that is a triage exercise and a prioritization exercise. And in one dimension, you would line up your estimates. I mean, this project is a 10%, this project is a 12, this project is a 17, this project is a 22. And that would seem you could rank order them, and you would do as much of the 22 as you possibly could, or as much as was available. And then only after you exhausted that, then you'd cascade down to the 17, so on and so forth. The thing you should also do is recognize that there's more than one factor at work. So is the 22 a much more riskier scenario than the 11? And again, at the risk of being challenged to actually do one, which I couldn't, I think about the world in terms of Monte Carlo simulations as opposed to expected values. So expected value, that's an easy problem. Monte Carlo simulations, not so much, because the Monte Carlo will reveal to you at least the possibility that you have some very bad outcomes along with the expected value number. So thinking about the dispersion of those returns, again, just conceptually, is an important tool to tamper and guide and in an approximation sort of way, make appropriate, lightly levered financial decisions.
So given the business model that you have,
And if I may, in our conversation when we met, you talked about teaching behavioral finance. I think behavioral finance, when it brings into the notion emotion and fear and greed and all those sorts of things, that's a very valuable thing to add to the tool set of the quantitative disciplines as well.
in the principles of insurance underwriting on the insurance side of the business in Markel, there will be some very strict rules about whether to accept a risk or not and how much capital to deploy. Do you think that it's analogous to what you would be doing on the investing side? Would you have some very strict guidelines about this is the risk that I'm not going to expose my company to?
Yes.
Beyond that, so is there a similarity? I mean, what can you learn from the insurance world about position sizing in the investing side?
Well, I know you're used to long answers from me at this point, so I was just giving you a short one. Is there an analog? Yes. And to expand on that just a little bit, so in insurance, what you're trying to do is make sure that you minimize to the fullest extent possible the risk of ruin, the risk of making a decision that could ruin you. So investing is the absolute opposite side of the exact same coin. So if you're trying to compound and you're trying to build a long-term record, what can you do that would have the expectation of positive outcomes and have rules and checklists and tools that would try to keep you from engaging in things where you'd have the risk of ruin, of zeroing out. Same discipline, same idea.
But would you be happy to invest in an investment opportunity where you could lose all the capital, but there's an expectancy of a gain, but you're not exposing a big part of the balance sheet to that?
Well, you
Like you do in venture.
correct. That is a legitimate discipline. I am not very good at that. So it is my tendency, because my temperament is such that I'm more comfortable with tighter dispersion things. There's nothing wrong with what you suggest. It's mathematically correct, but it's also good to know what you're good at and what you're not good at. And I hate losing money. It's too hard to make money. So I try not to be in situations where you really do expose yourself to zeroing out. Now, there are a lot of venture capitalists out there who are far richer than I am or ever will be. That's fine. That's what they know how to do. There's also a lot of venture capitalists out there who have zeroed out, but you don't hear about them. You don't know their names. So the amplification effect that happens in that world is a lot more than the amplification effect that happens in my world. So it's like going to Las Vegas or Macau. If you see people going to those places, they're talking, they're happy, they're excited. If you see the planes coming back from those places, very quiet. Because people talk about winning, but they don't talk about losing. It's behavioral finance.
So you have 132 stocks in your 13F today, and one day you were buying Amazon, a year later we saw Starbucks or Under Armour. How do these ideas pop up? We're talking about Buffett and Munger, that he keeps talking about DCF, but he said no, he's never done it. Is it like there is a screener, but that screener is not on a computer, but there is some screener here where these ideas just pop up? How do these ideas come?
Actually, not doing the technical screens off a Bloomberg terminal, but again, with the mindset of a DCF, I think both Amazon and Starbucks qualify as DCF thought process stocks, because you can look at the cash flows. As businesses both produce cash money. And this is where it's good to be an accountant to try to discern the difference between the accounting presentation and the real cash money, is a phrase they use, real cash money. I know what the accounting is, but I want to see the real cash money, and to be able to translate that back. Again, if you look at either one of those things and you make some, I would say, reasonable assumptions about what the cash flows are likely to be, and what sort of reasonable assumptions you would make about discount rates and the cost of capital, and you have a long-term time horizon, it's not anything outside of the realm and discipline of value-based investing to want to own those businesses. They have a high price to book, or perhaps current high price to earnings ratio on the apparent circumstances today. But once you start adjusting the accounting for the cash, and once you start extending your time horizons, I think you can make a discounted cash flow analysis case for owning those businesses, and that's why we own them.
So related question, as Yogi Berra says, the future aren't as it used to be, and as we know, the value of a company is the present value of all future cash flows. So any pointers on how to identify the competitive durable advantage? I mean, as you mentioned about Amazon or Starbucks, that they will throw free cash, but what are those few key things that you look at while buying a stock?
Well, it's many of the same things that we've all heard about from Buffett and Munger and the teachers of that nature. You are a consumer. You are in business. You know things. You observe companies. You have to compete against people. You know who's better and worse. You have a lot of data just by walking around and thinking about your own experience, and being curious about that sort of stuff. I think Buffett and Munger also both talk about the discipline of inversion. So one of the ways in which you could think about how good something is invert and say, well, how would I like to compete against them? And if you have to compete against them, wow. You don't want to invest in that business, and you probably do want to invest in that. Those are things that are helpful in identifying businesses that meet the test.
And you think that the kind of technological disruptions we are witnessing, the digital disruptions, the disruption in consumer behavior, the disruptions in policy and governance globally, the way we are going against the globalization and several of the policies, the way the liberal democracy, the liberal economy has been, will that change the way you look at sustainable competitive advantage, that one fine morning a Dollar Shave Club can threaten a Unilever, or maybe several other businesses can come under severe threat of having a sustainable competitive advantage?
Well, where did Saurabh go? Did he slip out? I'm so sorry he can't.
For finding the next big idea for you from India.
Yeah, well, that's part of it. But the answer to your question, will the idea of how you think about sustainable advantage change? The answer to that is no. The discipline, the technique, the thought process is consistent. And I'm sorry Saurabh is not here right now. You can all ask him about this when he gets in. This is our secret inside cocktail party joke. So we were discussing something, and I said, well, in order to think about that and have our next layer of discussion, there's a book I want you to read, and it's called The Way We Live Now by Anthony Trollope. And it was written in, 1870s, 1880s, something like that. And it was about the growth of the American railroad industry. And this guy who lived in the London salons, we got to stop talking about it. But my point is that there was something that happened a long time ago where all of the behaviors and all of the human nature still manifest themselves today. So in order to have a current discussion, here's something you can think about that happened 150 years ago, and all of the intellectual processing to think about this idea, it's the same. So the specific businesses will change. We might not be talking about railroads. We might be talking about some digitally informed business, but the thought process is the same.
Another question, that how do you track such a large number of stocks, 132 positions?
Well, mechanically, the way I think about it, so in America, baseball is a big deal. Less than it used to be, but as a kid, I was a fan of baseball teams. And the way baseball is organized is that you have 26, 28 teams that are the major league teams, the New York Yankees, the New York Mets, the Philadelphia Phillies, the San Francisco Giants, the Houston Astros. Those are the major league teams that are in the big cities. And each of those teams has a farm system. So there's a triple A team, a double A team, and a single A team, where players that are young start out and they try to work their way up to the system where they can get to the major league team. Well, having 132 stocks for me is like being a manager of a baseball organization. So if you're running the New York Yankees, you have 26 players on the roster of the New York Yankees, but you also have 26 players roughly on your AAA team, on your AA team, and your single A team. So that gets you to 104 players altogether in your system, plus who you might be looking at as potential drafters. So it's not different by order of magnitude than the sort of number of names you're thinking about. Position size. Those 26 players in the major league team are being paid a lot more money than the 26 players on the single A team. So I have a portfolio where the top 20 names oftentimes represent 2/3 to 70% of the value of the total portfolio. So that's really what moves the needle. And that's what the bulk of my time is. But just because of my own habits and proclivities and tendencies, I find it easier to make myself think about smaller things that could be big if I own a little bit of it. So even if you have someone who, excuse me, would make this pitch that they're part of the reason that they're a great investor is because they only own 10 stocks and they're concentrating their portfolio massively into a limited number of positions. Well, good for them. Nothing wrong with that at all. But I would suspect they're also looking at other things to see if one of those 10 should be replaced with something else. So no matter how many stocks you own, whether you own 10 or 100, you should be looking at a lot to compare and contrast and look at your opportunity set. And it just happens to be a personal habit that I'll buy 100 shares or something, or 1,000 shares, a very small position that won't make any difference to the overall economic performance of the portfolio, just because that's the way it helps me to look at things and think about them.
So is it like keeping a lot of those smaller positions as keeping under the radar, and as the conviction goes up, you will size them up? Or is it like optionality, that a small thing where, as Professor was talking earlier, where maybe the downside is probably greater and that there could be substantial upside, but the level of conviction is low?
Really more the former. It's the notion.
Keeping under the radar so that...
Correct.
Plus, I think because he has money coming in every day,
Right.
so that he doesn't have to sell something to buy something.
Correct.
He's always a buyer of things.
On a net basis, that's true. Has been so far. May it always be. And that's very helpful, by the way. So, in the 28 years that I've been at Markel, that would be 28 times 12 in terms of number of months, so close to 300 months roughly that I've been there. Of those 300 months that I've been at Markel, I think maybe in 298 of them, we've been a net buyer of some stocks. So maybe right after 9/11, we might have been woozy enough to maybe not have bought something that month. Or right after Hurricanes Katrina, Rita, and Wilma, which were major events in the property casualty world, we might have taken a month off and just sort of made sure where we stand. But every other month that I have been there, we have been a net buyer. And that creates dollar cost averaging, which is not a fancy technique, but I think it's amazingly powerful. And that if you find a good business, find good people that have the ability to continue to grow, to be nudging and just nibbling at it over and over and over and over again, they become huge, epic, powerful positions over time. Berkshire, to some degree, is one of those positions for us. Marriott Hotels, we've owned it for more than 20 years, and we've bought it episodically all the way along, and it's been a wonderful performer, and it's a large holding for us that's been dollar cost averaged into over a long period of time.
Tom, I want to ask you about signal to noise. This is a big problem that we're facing, and the noise keeps getting worse, and there's so much cacophony out there, and you have long holding periods, and there is news coming in about those positions. Every quarter, every day, there's something coming out.
Right.
How do you decide what's important and what's not? For the most part, most things, in the way I understand you, is not a big deal. It's not news. So how do you decide this is significant and significantly negative for me to change my mind about my hypothesis? Because for the most part, you don't. But when you do, how do you decide this is something which is a very powerful signal for me to change my mind?
Well, I suspect this will probably be a deeply unsatisfying answer. The truth is, I just go to work every day and I think about it. And it may look and appear as though I'm not doing very much. But I'm reading and thinking and talking to people and pondering all day, every day. Even when I'm on vacation and traveling and going different things, I'm learning things, I'm experiencing things, I'm getting sensations of things, and that causes me to either be more favorably inclined to things or less favorably inclined to things. And there are times when something dramatic happens that would cause me to make a dramatic decision, but that's relatively rare. More and more, it is the case that I'm just dialing it up or dialing it down in gradual ways. Now, the accumulation of things tends to be much more gradual than the selling of things. So, if through data and daily observation, I continue to like something, I sort of continue to buy it bit by bit by bit by bit. If something happens where I've lost confidence in the management, or I'm deeply concerned about something, or something has disturbed me, I can sell something very quickly. So I sell much faster than I buy.
No, I'm talking about the fears about erosion of a moat because of a new business model, for example. I mean, you talked about Marriott, you held it for 20 years, and we know that there is a different kind of a business model in that industry, Airbnb, which has made a lot of people very jittery about it, for the right reasons. So when that happened, how did you think about it at the time when it was happening?
Well, that's an excellent case study and an example, and the answer is I did think about it. So first step is awareness. So you own Marriott for a long time, and then all of a sudden Airbnb comes on the scene, and people were worried about it. They're not wrong. So I sort of dimensionalize and try to size markets a little bit, and I think about what a Marriott represents to a traveling business person and the location advantage and all those sorts of things, and how many people want strangers in their house in an Airbnb setting and what parts of it. So you can get some frame of reference, and in that particular instance, what I concluded at the moment, subject to change as other data comes in, is that the business of Marriott is not fundamentally handicapped in a meaningful way by Airbnb. Airbnb is just a new entrance and a new competitor, and I think it really expands the size of the market in total rather than destroys the growth rate of Marriott. In addition to that, so again, awareness of the fact that there is an endowment effect is the first step to not being a victim of it. So I know what you're talking about. I agree with you. Mentally, I try to have the discipline not to be governed by that too much. So awareness helps you do that. The second thing about the endowment effect, which is real for us, is that we're taxpayers. And the ability to hold on to something allows you to defer the cash payment of the taxes on the gain, and you do have to pay it when you sell it. So if I sold something like Marriott, I would not be getting 100-cent dollars to reinvest. I'm getting, in today's tax rates, call it 80-cent dollars. And if you do the math on what you have to earn on an 80-cent dollar that you invest compared to what you're going to earn on the 100-cent dollar that you have, that actually sets the bar a little bit higher for making the trade than not making the trade. And third level, behaviorally, that suits my temperament. I am well suited to be in the job and have the responsibility that I do because I'm measured in after-tax rather than pre-tax ways. Most people in the investment world are not measured on after-tax. They're measured pre-tax because tax is unique for any particular investor, and you can't distinguish the skill of the investment manager by somebody's individual tax rate. So I understand why we do that, but I also hope that others understand why, in my circumstances, I would use a different measurement tool, because in terms of the real economics to me, to Markel, the after-tax returns are more important than the pre-tax returns. So the endowment effect kind of helps us.
It does, but there's a sort of trade-off here, isn't it? Because on one hand, you're saying that I don't like paying taxes if I don't have to, and on the other hand, you're worried about impairment of a mode of a business.
Right.
Would it be right to say that when you are really thinking about the impairment of a mode, you shouldn't think about taxes at all?
Yes, those are two independent things. Correct. So you're right, there is a trade-off. But at the same time, both of those factors would be real to us. So to make it really real, if I thought there was a business where the moat really was impaired and damaging, I should be happy to sell it and pay the taxes. And I just need to be intellectually honest about, don't let the fact that you don't want to pay taxes color your thinking about whether this moat is damaged or not. Two independent events. I agree with that.
Got it. So let's go back to Marriott, since that was a great example.
Right.
I want to work on that. What, and you said it's subject to change. Your own opinion right now of holding on to it is subject to change.
Correct.
What kind of data would make you change your mind about Marriott?
Well, every quarter they report the results. Every year they write an annual report. I see the trends, and if I saw some deterioration in those trends, that would cause me to question my thesis more. And that's a very muddy thing, because to your point about the signal and the noise, what's going on with the general economy? What's the demand for room rates? What are the interest rates? All of those sorts of all those things factor into it. So there isn't a clear-cut, good, crisp answer to your question other than, well, go to work every day and think about it and be equally willing to act or not act. And that is hard for people to equally weight the value of both of those activities. As Buffett, I think, once joked, you make more money with your butt than your brain. And the sitting on something, it may not look like you're working, but actually you are. You're creating value for your clients.
Do you think it makes sense to, and a team, you're building a team, Saurabh is working with you now. Do you think it makes sense to have somebody to help you think through the biases that you might be having, like the endowment effect, that you're too much vested, too much emotionally attached to this particular situation? Do you think it makes sense to have a colleague who will question your attachment to a business?
Yes, and I expect we should probably just have two more questions or so and then break. The answer to your question is profoundly yes. Now, I have a couple of colleagues within the firm of Markel, but I joke, for the first 17 years of my time at Markel, I was a one-man band, and I had no investment colleagues other than Steve Markel, who did other things as well. But I also joked that I had a virtual staff of 40 people. Because if you look at the shareholder list of Markel, some of the best investors in the world own stock in Markel. Many of them I knew personally and have developed relationships with those people over time. And you engage in discussions with them, and I pointed out to them that the ironic thing is, you're one of the great investors of the world, but since you own Markel stock and I'm making decisions at Markel, I'm managing money for you. Guy's smarter than me. Well, then I also I'm trying to be humble enough to say, well, I know you're smart, and because you have invested in Markel and you want Markel to do well, if there's something that I'm doing that's stupid, in your opinion, tell me. If there's something you think I should be doing that I'm not doing, tell me. I deeply appreciate the dialogue and the relationships of things like that. And again, these are long-term notions. It's not short-term trading or any of that, but just long-term thinking. So those relationships with people who were friends of Markel and rooted for Markel over time do exactly what you say. Now, some of them can be very friendly and pleasant in tone, and some of them can say, "What are you doing?" But trust me, there are no lack of people who are willing to second guess what I do. And it's funny, and I observe from having gone to the Berkshire Hathaway meeting for 28 years in a row now, I told somebody that, someday my goal is to be second guessed as much as Warren Buffett is. And if you've been to the meeting, it's funny because here's the guy who's been the best in the world at what he does for long periods of time. But inevitably, there's a strain of questions within the context of the meeting that basically start out saying, Mr. Buffett, if they try to be respectful, I know you've done very, very well at this, or you're good at that, but I really think you're missing it here. Or have you thought about this? So people second guess the best guy who's ever done it. So if I get second guessed like that, great. And I suspect he hears that. He processes that. There's information that comes from that. There's information and processing that comes from hearing people who think you're doing something silly as well. And I try not, the older I get, the better I get at not being defensive about it. Again, behavioral kind of stuff, and being able to listen and discern, because that's the way you can get the signal and not be flinching about the noise. Two more questions.
Just to take that point a little further, so let's say throughout 60s, 70s, 80s, 90s, one would have thought Walmart, this is like not a stock buy and hold, it is like buy and forget. Cash throwing machine, incredible machine with such a deep moat. And I just said that, okay, I'll keep watching the quarterly numbers and then it will give me a signal. It will be pretty late to know that the sand is shifting. It's the Amazon, what it can do to the Walmart and the other retailers. I'm thinking about that situation. There are several other industries in the world. So let's say if the EVs and autonomous cars and vehicles, what can happen to the insurance business? Mm-hmm. I talked about the change in the consumer behavior, a Dollar Shave Club versus Unilever. In energy, all the traditional energy companies versus the renewables. And tomorrow, if Tesla does something, large number of businesses are under, I would say, existential crisis. Correct. And in that kind of period, how to look at that sustainable moat and what valuation to pay today to have that kind of belief in the future cash flows.
Right. Well, to your specific example that you started with, and answering your question at the same time, Walmart is a stock that I used to own that I don't now. So that's exactly an example of just trying to be discerning and thoughtful. And I did not time it perfectly in buying Walmart. I did not time it perfectly in selling Walmart. But it was not a bad holding for us. We did okay. We made money on it. And I think that about it. So how do you do that? Well, you think about it every day. And you go to work. And the Walmart 5 or 10 years before I bought it, before Amazon existed, was so good, and they were so well known, and people loved it so much that it was selling for 40 or 50 times earnings. Now, actually, I can remember doing this for our board for a letter I wrote, because people would say, why don't you own Walmart? Why don't you own Walmart? That's a great company. It's doing great. And I'd say, you're right. But here's the thing. And I did this, I think, 20-year chart. And I said, well, here's Walmart today. And this is the market capitalization of Walmart today. If you extend that out 20 years and you wanted to earn 10% a year of compound annual growth rate, simple math. Here's the number it has to be in 20 years. Well, the number of Americans, and this was largely a domestic company at that point in time, was 300 million. And let's assume a 3% growth rate in the population between now and 20 years. So you get a number there. And then you get sort of the normal profit margin of Walmart and the money they're making right now, it's 2%. It's a low profit margin business. So then you can see how much sales per capita they're doing. Just 5 or 6 simple ratio numbers. Well, if you extended it out 20 years, what it meant is that every single man, woman, and child in America needed to be spending $832 a day in Walmart for that math to work. What must be true? That is what must be true for Walmart to have been a good 20-year decision when I was looking at it at those entry points. I said, I don't think that's true. So I didn't buy it. What happened technically with Walmart is they continued to execute quite well. The growth rate slowed, things got tougher. That PE ratio went from 40 down into below 20. So between 15 and 20, I thought it made sense. And I thought you could make that math work. So I started buying some. Over a period of time, what I observed is the competition was getting tougher. All the things you mentioned were becoming greater rather than lesser factors, and it just couldn't get traction. So I said, it's too hard, and moved away. That's exactly how it all happened, and that's exactly what we do all the time. I look at something, and I think, what must be true for this to be a good idea for 10 or 20 years? And if I can't see that is likely to be the case, I probably shouldn't own it. Last question.
It's 8:30, maybe 3-4 minutes. We can do a rapid fire round,
Okay.
maybe. Why did you hire Saurabh Madan? If anybody else in this room is interested in working for you, what are the qualities that you look for while hiring people?
Well, I will tell this, and so as I said, I was 17 years before I hired the first person. It was and then it was 10 years later than that, so that I hired Saurabh. So please hold off sending me any resumes for a while. We're very slow and gradual in our hiring.
On a more serious note, the qualities that you look for while hiring people.
All of those factors that we've talked about in terms of the investment decision, and again, tying investments to business. So, I talk about wanting to invest in businesses that earn good return on capital and don't use too much leverage, because really that is a marker of a business that's serving its customers. I observed that Saurabh had a heart of service and trying to help others, and so that's matched up in that sense. The second thing, the equal measures of talent and integrity, because if you're having a partner, if they have talent but not integrity, well, they may do well, but you're not going to. If they have integrity but not talent, they may be nice people, but they can't get the job done. So what good does that do you? So I observed that he had measures of talent and integrity. The third thing, reinvestment opportunities, a business that can grow and compound its capital. Well, the human analog to that is curiosity and intellectual horsepower. So you have the synapses and the brain power, but do you do anything with it? Do you want to learn? And had a spirit of learning. And then at the fair price. And one of the things that Saurabh extracted from me in terms of his compensation is that I had to agree to come to India with him. So here you are.
It is your first visit to India. Any impression you have formed so far?
It's just a marvelous time, and to see all the mixture of things, and it's so much more complex than what one can appreciate from afar, and there's much to ruminate on and think about. Very helpful for additional frame of reference and sorting out future signals and noises.
And before we let you go, in case you want to share your views on Donald Trump.
It's been nice being with you.
So I think as someone said that, give me your silver, take my silver, take my gold, give me your wisdom. Thank you so much for sharing your wisdom with all of us tonight.
Thank you. Thank you. Thank you. Thank you.
For the token of our
Thank you so much. Thank you.
some books.
Oh, very good, thank you.
which I'll give it to you later.
All right, thank you. Here, there's one annual report. I'm not going to carry this back to Richmond in case anybody wants a Markel annual report.